Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the financial sector: the surge in gold prices. Gold has long been considered a safe haven asset, and it seems that investors are flocking to it once again amidst concerns about global economic growth and uncertainty. According to recent reports, gold prices have skyrocketed to new heights, with some analysts predicting that they could reach as high as 8,500 per ounce. That's a significant increase from the prices we saw in 2025, and it's got many investors wondering if this trend will continue. But what's driving this surge in gold prices? Some point to the decline in interest rates, which makes gold a more attractive investment option. Others cite the increased demand for gold from central banks and ETF investors. And then there's the issue of inflation, which can erode the value of other assets and make gold a more appealing store of value. Of course, it's worth noting that the price of gold is subject to fluctuations and can be influenced by a wide range of factors. As J.P. Morgan global market strategist Nikolaos Panigirdsoglou noted, higher prices of gold raise the possibility of profit-taking or even a period of consolidation. We'll be keeping a close eye on the gold market and bringing you updates as more information becomes available. In the meantime, it's essential for investors to stay informed and consider their own financial goals and risk tolerance before making any decisions. And that's not all. We're also seeing significant movement in the silver market, with prices surpassing 100 per ounce for the first time. This is a developing story, and we'll be sure to bring you more analysis and insights in the coming days. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating discussion about market trends and expert insights. Recently, Sandeep Subharwal shared his thoughts on various stocks and industries, providing valuable perspectives for investors. He touched on the commercial vehicle cycle, highlighting that it's on an upswing, with demand driven by replacement needs and fresh demand. This trend is expected to continue, supported by sustained economic activity. Subharwal also discussed Ashok Leyland and Tata Motors, noting that while Ashok Leyland is operationally strong, its valuations appear fully priced. In contrast, Tata Motors' CV segment might offer more attractiveness from a valuation standpoint, especially considering potential efficiency gains. Moreover, Subharwal sees ITC as a value buy, given its solid performance across segments, including cigarettes and FMCG, and its dividend announcement. He cautions, however, that volume trends will be closely watched following duty changes. Lastly, he expressed skepticism about Swiggy's ability to balance growth and profitability, pointing out the intense competition in the food delivery market. Subharwal questions ambitious price targets for such companies, emphasizing the challenges they face in reducing losses. These insights offer a nuanced view of the current market landscape, underscoring the importance of careful analysis and consideration of multiple factors when making investment decisions. As we navigate the complexities of the financial world, staying informed with balanced perspectives is key. Welcome back to the Riskwiser Zone. Today, we've been exploring the complex world of finance and investments. As we wrap up this episode, let's take a closer look at some recent developments in the Indian economy. According to Chief Economic Advisor V. Anantha Nageswaran, India's growth is expected to continue, driven by a combination of factors including consumption, investment, and exports. Nageswaran highlighted the importance of agricultural reforms in enhancing productivity and boosting economic growth. He also noted that the proposed India-European Union trade agreement could provide a significant boost to labor-intensive manufacturing sectors such as footwear, gems and jewelry, and textiles. On the topic of foreign portfolio outflows, Nageswaran described these flows as cyclical and emphasized that India's policy levers are largely domestic. He suggested that the government can provide tax certainty, maintain reasonable tax rates, and streamline processes to attract investors. Despite challenges posed by higher U.S. tariffs, labor-intensive export sectors have managed to find alternate markets. The recent tax cuts, lower inflation, and rising precious metal prices have also supported household spending, contributing to a 7% growth in private final consumption expenditure. As we consider these developments, it's essential to maintain a balanced perspective and recognize both the opportunities and risks present in the Indian economy. As investors, it's crucial to stay informed and adapt to changing market conditions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.